This is level 2 of the CFA program, the topic on equity valuation, and the reading on market-based valuation, price and enterprise value multiples. You know, I like telling stories about my family, especially my children, and if this reading were about entirely my particular household, it would go something like this. I say to my sons regularly, you know, your mother and I, we've done a lot for you during your lifetime. You know, things like put a roof over your house and feed you and pay for your education and do all this fun stuff. And I said, what have you contributed to the household? And my sons will say, well, you know, I made my bed last week and I took out the garbage one time and I did really well in the basketball game the other night. And I look at them and I'm like, dude, your ratio is way too low. Look at the neighbor kids. Look at all the stuff they're contributing. And that's really all we're trying to do here. We're trying to figure out in this reading how our children perform in our household. But of course, you know, children might be kind of a loose analogy, but take just the simple PE ratio, which is going to be a focus inside of this reading. You know, a company like McDonald's might have a PE ratio of, let's say, 20, and that means that for every dollar in earnings that investors are willing to pay $20 for that $1 in earnings. And a company like Malibu Boats might have a similar PE ratio at some static point in time, but the volatility of those two PE ratios over time and the trailing and the leading PE ratios in those two companies might be completely different. But it's really a good place to start for, you know, this concept of relative valuation, so we can see, okay, is this stock expensive or is this stock inexpensive? And you'll see that as we go through quickly some of these learning outcome statements. So look at that first one. And this is probably one of the more important ones there. Distinguish between the method of the comparables and the method based on forecasted fundamentals. So that's pretty much what we do in the CFA program. We try to do some kind of fundamental analysis, right? Find the core or the intrinsic value of a company and then compare it to some other kind of a market value. But we also then have to look outside of the company and say, all right, what is this company over here, this company over here? What do they look like compared to what we look like? So look at some of these next LOSs, you know, a justified price multiple, justified leading and trailing, underlying earnings, earnings yields, fundamental factors. And then, boy, the good news is that we keep going with these LOSs. I think when I looked at the actual reading, we go down to R, all the way A through R. I have no idea how many numbers that is through R, but you guys are probably smarter than I am. We'll do some terminal value. We'll look at some financial stuff. And then in the end, we'll look at some differences between types of means. And that'll be an interesting part. So let's go ahead and recap here. Remember, we're trying to figure out our children and what their performance is. But of course, our children now are individual companies. So how do we do this? Well, a couple of different ways here as a recap from level 1. So price multiples, some measure of fundamental value. I've already talked about the price earnings ratio, but there are other kinds of ratios, price to cash flow, price to book value, etc. We'll talk about those as we go through the slide deck. How about enterprise value multiples? This is kind of like a fundamental evaluation of a company based on its total market value, of course, swinging all the way back to 1958 in Modigliani and Miller, when they taught us that the value of the firm is a sum of the value of the debt plus the value of the equity. And then we can also throw some, boy, do I want to say this right now because the reading doesn't emphasize this, some type of behavioral issues or technical analyses that are going to lead to some kind of momentum. Momentum can be upwards, momentum can be downwards, and this could be primarily technical analysis, or it could be some combination of the two. All right, let's look at that very first LOS, which I said just a moment ago how important I thought it was. All right, so what are we doing here? The method of the comparables. So what we're going to try to do is value an asset based on the multiples of something that is super similar. What does similar mean? I guess you could say similar in size. Size meaning an asset base, I guess. You could say similar in size, meaning maybe in the total amount of the bonds. You'd probably go with size on that one, left-hand side of the balance sheet. But then you've got to go ahead and consider the risk associated with each of those kinds of assets. And so, looking after the last slash there, a benchmark asset. And this is something that the CFA Institute attaches a great deal of import to, and as well as it should, because we want to make sure that we compare ourselves against something that is, can I say, virtually identical to us or virtually identical to the company in question. And of course, there's some economic rationale behind this. Is that if I'm a basketball player and I do this and this and this, and somebody over here is another basketball player and they do this and this and this exactly the same way that I do, then when we sign a contract for a professional team, we ought to make the same salary. But then how about a method based on forecasted fundamentals? This is really what I believe is kind of the heart and soul of being a good financial analyst, is to look at the fundamentals of a company. And again, we can go back to Modigliani and Miller. What did these two guys tell us? That the value of the firm is based on the quality of the asset. So notice what we have there in those little circles or ovals. Profitability, right? That includes things like net income and operating cash flow and free cash flow. Financial strength, that looks like, okay, what does the right-hand side of our balance sheet look like? What is the amount of debt versus the amount of equity? Is this an optimal capital structure? And then, of course, growth. What's the goal of the business? Maximize shareholder wealth. Well, how do we do that? We invest in projects that are going to offer a positive net present value, which means that hopefully as we expand, right, goal of the business to brand these product lines, we'll have some growth. And so either of those methods can be used to determine some kind of a price multiple. Now, the reading emphasizes the term justified price multiples, which means that there might be multiples out there that are unjustified, that probably make no sense from a fundamental perspective. I mean, I could take a PC ratio. I could say, okay, here's the stock price versus the number of clouds, C for clouds in the sky. I mean, that's a price multiple, right? But it makes no sense at all. So justified means that, hey, we're looking at this from the perspective of comparing it against something that's similar and based on fundamentals. Now, how about this justified price multiple concept? All right, so a justified price multiple is the multiple for a fairly priced stock, right? That makes perfect sense. So if actual is greater than justified, then the stock is overvalued, and then, of course, just vice versa. So let's go ahead and take a look at a super quick example. We have a company that's trading at $50 a share, and the EPS at the end of this past year was $5. So take 50 divided by 5, so you get 10, right? And so we've got that trailing PE. Trailing mean that we're looking at history rather than some kind of a forecast, right? So we're looking at history, trailing PE of 10. The average trailing PE for peer companies is 20. So that means that investors are willing to pay $10 for our $1 in earnings, but our peer companies, they're willing to pay $20. So we could probably make the conclusion that this company is undervalued. And there's an alternative calculation there at the bottom of the slide. Now, how about we do it based on forecasted fundamentals? So we give a bunch of information: current stock price, next year's expected EPS, so that's important, dividend payouts, required rate of return. All right, so notice in those colored circle points there that we have variables that are inherent in the core assessment of a company, fundamental analysis. All right, so the PE ratio, what did we have? 30 over 5, that gives me 6. Next year's dividend is going to be $1.25, right? That makes sense. And so the intrinsic value, notice that third circle point there at the bottom, that's just the Myron-Gordon growth model. Dividend sub 1, don't forget how important that subscript is, divided by the required return on equity, which of course we can get from the capital asset pricing model, minus that growth rate. So that gives us around $21, right? So if we compute that leading PE ratio, we have that around 21 divided by 5. So that gets us 4.17. All right, so you ready for this? The actual PE ratio, 6, is higher than some type of an estimated PE ratio, this leading PE multiple of 4.17. So we make the conclusion that it is overvalued. And so this makes a lot of sense from a test creating standpoint. If I'm creating these exam questions, so I give you, let me go back here. So I give you all this stuff here and ask you to make those calculations. Then I give you all this stuff here, ask you to make those calculations. And then the third question is, so first question is compute, second question is compute, and then the third question is, hey, tell me what this means, right? Interpret. So I love when these LOSs use the action word of interpret. It means that either the CFA Institute is going to give you some information, or they're going to ask you to calculate it and then interpret it. And the interpretation here is really a simple one. We're going to either have overvalued, undervalued, or fairly valued. Next LOS, rationales for. So what do we do? What do we like this? All right, earnings drive stock value. We know that back from Modigliani and Miller. This is simple to calculate. And there's academic research that shows that differences in PE ratios are related. They're highly correlated to long-run average stock returns. So these are good reasons why we want to use these models. But then again, there are some drawbacks. What if you have a 0, negative, or super small earnings? That PE ratio doesn't mean a whole lot. Go back to the childhood multiple that I introduced a few moments ago. If you put my wife and my contribution in the numerator, and then you put my son's contribution in the denominator, so my wife and our contribution might be $1 million and theirs might be 8. So I don't even know what that means. So drawbacks. Remember, if you have something close to 0, it's probably meaningless. And then of course if it's negative, I don't really know how you interpret that. Notice that the drawback about volatility. This is why I gave you that example about McDonald's, which is, boy, I always hate to say this, but it's a relatively stable company, stable earnings, relatively consistent stock price over time. I hesitate when I say that about stock price because it does go up and down. However, compare that to a company like Malibu Boats, who makes all these different kinds of boats for, water skiing and going way, way out in the ocean. The volatility in earnings and volatility in PE ratios then make these difficult to interpret. So what was that last LOS? Interpret a justified price multiple. Well, just like when we compute the return on an asset, we have to worry about its standard deviation. Well, just like we worry about when we compute the PE ratio, we need to worry about volatility. And then remember, we had that one reading, and maybe it was a handful of readings on quality of earnings and persistence and sustainability and all that. And we were told that we really need to go and read all of what the management says about the financial statements. So look at that last one. Management's discretion for accounting may distort reported earnings because, of course, management has some type of an incentive to report higher earnings rather than lower earnings. Let's see, I think I've already defined this here. Trailing PE ratio, notice that arrow points that way, and then leading PE ratio, that points this way. So trailing, we just look at historical stuff. leading PE multiples, we've got to go ahead and use some kind of a fundamental analysis or maybe comparable analysis to estimate what those prospects are for the PE multiple. So look at the last two circle points there. This is probably important as it relates to the interpret part of the LOS. So trailing preferred when forecasted earnings are unavailable. All right. Preferred, leading PE, preferred when trailing earnings do not reflect the future. And of course, I always ask my students this all the time whenever they say something like, oh, hey, Jim, I computed the beta for this stock over the last 3 years and it was 1.2. I always say to them, hey, that's super awesome. It's great that you used regression analysis, you used some covariances and variances, and you understood what that means for that time period. But then I say, does it have any relevance going forward? And then, students scratch their head and they say, okay, then what do we do, Jim? And I'm like, well, this is what it means to be a good financial analyst. You figure it out. All right, let's go ahead and compute these PE ratios that we just talked about. All right, so we've got earnings, forecasted EPS, outstanding shares, market price. All right, so current year EPS, so we take that 50 million divided by the number of outstanding shares, so we have 62.5 per share. Trailing PE, there's our stock price of 20 divided by that 625, so that gets us 32. And then the leading, so our forecasted EPS was 120, so that gets us to 16 or 17. So note that the trailing PE ratio is about twice as large as the leading PE ratio. And, there's nothing wrong with having trailing and PE ratios that are not close together. However, the next question then becomes, why are they so far apart? What has happened to the company that is going to dramatically reduce that PE ratio? And, there can be a whole slew of reasons for this, but that's why we do fundamental analysis. All right, how about issues when determining EPS, right, denominator? So we have earnings per share. So a couple of things here. So EPS dilution. All right, this is a really important concept because the Institute talks about things like executive stock options, right? It talks about things like bonds with embedded options like a convertible bond. So, you compute EPS over the number of outstanding shares, but that denominator doesn't reflect the number of potential outstanding shares. If the executives exercise their options, which will necessarily increase the number of outstanding shares, or those convertible bondholders convert their bonds into shares of stock, which will also increase the denominator. So you got to be super careful about what you're using in the denominator, and you need to probably make some adjustments for that. How about the underlying earnings? Just think about an income statement. You have revenues, expenses. You have all sorts of expenses there. So you end up at the bottom with net income, and you have to ask yourself, okay, if that net income is 10, is it, let me go ahead and read right from that circle point. Is it persistent? Is it continuing? And is it a part of core earnings? Which means that somewhere in there, we might have non-recurring items, which of course, the most recent example of a hopefully non-recurring item is the expenses associated with COVID. Hopefully we don't have to go through this every year. But there are lots of things that are non-recurring. And so we need to make sure that we consider the non-recurring nature of one of these accounts. For example, I know I gave this to you in probably that merger chapter, 20 years ago or so. Procter & Gamble sold its Jiffy peanut butter product line to Smucker's. So you have an asset sale, right? A product line sale, which was in the several billions of dollars. And so you can't just expect that Procter & Gamble is going to generate that $2 or $3 billion every year. So you need to throw that over on the side and say, okay, that was a one-time event, just like a natural disaster, just like COVID, hopefully, etc. How about normalized earnings? This is an interesting concept, normal. I'm not sure what normal earnings means, but normalized earnings means something like this. We have a business cycle, so our cash flows could look like this, right? And so what we try to do is go like that. We try to normalize them. So what do we have in the slide deck? Slide deck, adjusted for business or industry cycle influences on earnings. Because, maybe we sell lots of stuff right before winter, or maybe we don't sell anything in summer, so we kind of switch those around and pretend like we have more stable earnings throughout the year or throughout the business cycle. And then, of course, that last one over there, I've said this to you repeatedly that, boy, the CFA Institute does not require us to be certified public accountants, but they would like us to know and be able to speak the language. And then this is probably the most important part of why we did all that financial statement analysis stuff, is so that we can look at these financial statements between two companies. And of course, we're doing PE multiples as well. We can look at those two financial statements and say, okay, this firm over here does this and this firm over here does this and this. They have the same current PE multiple. However, when I make adjustments because one person or one company uses this depreciation method, this company over here uses one method for impairment of assets, boy, now all of a sudden these two PE multiples are not identical. And so that's why we did all that work earlier, so that we can, I'm going to read this to you, adjust for comparability. All right, here are some examples of non-recurring items. So gains or losses. There's the Procter & Gamble one I said to you. Impairment, I did say something about impairment, loss provisions, and then changes in accounting estimates. And look what we have in purple down there: persistent, continuing, and core earnings. So this is a link back to those quality of earnings readings that we had a while ago. All right, so let's go ahead and compute a trailing PE ratio based on some underlying earnings. So let's see what we have here. Reported EPS from the previous 12 months, 5.5. All right, so restructuring charges, amortization, and impairment charge. And so there's our stock price. All right, so let me say a couple of things about here. So stock price, we get that from the floor of the New York Stock Exchange, right? That's easy. Impairment charge of 35 cents. All right, that's easy. We know going back here. So let me do this. So asset write down. So there's we know that's an extreme example of a definite extraordinary non-recurring item. All right, but these other two here, restructuring charges and amortization of intangibles. Now, I'm going to go ahead and make some assumptions here that are not written on the slide deck. So restructuring charges, there's 15. And so let's go ahead and say something like, you know what, for some reason, this company didn't include restructuring charges in its reported EPS this particular time frame, but it historically has done that. So now we need to try to figure this out. Here's where the artistry of financial analysis plays a huge role. And then the amortization of intangibles, let's go ahead and make the assumption that we think these things are going to probably continue. All right, so let's go look at the circle points down there. PE based on reported earnings. All right, so that's an easy one, right? 30 over 5.5 gives me 5.45. All right, so reported core earnings. So let's go ahead and take that 5.5 and add those three together and get the 624. And let's take then in the third circle point, the 30 divided by that 624 and get the 481. All right, so we've got a PE based on reported earnings, then we have a PE based on our kinds of adjustments based on my assumptions. But then this is what we want here, these underlying earnings. We're going to take that 5.5 and all we're going to do is add back that 35 because we know that impairment charge is a recurring item. And because of the management decisions on restructuring charges and amortization, we're going to go ahead and just say, hey, those things are probably going to repeat themselves. So you get the 585 and you put that into the 30 and you get 5.13. And so you get a sense here, this is a really cool slide, a sense of, the 545, that means one thing. The 481, that means another thing. And the 513, that's the underlying earnings. That's the value that we want to use based on some of our adjustments. So make sure when you read the vignettes that you pay attention to management decisions based on some of these items. Now, you know that any of these four, these are going to be non-recurring items in the overwhelming majority of cases, all right? But there are some leeway with management and its decisions, and that's why we did this in this slide. And by the way, this is similar to the example in the actual reading. All right, what did I say earlier about normalized earnings? I don't have any idea what that means, but let's go ahead and figure it out here. Adjust EPS to eliminate the cyclical component of earnings to show mid-cycle earnings under normal market conditions. And all I can think about this is if, think about two triangles that are sitting side by side, right? And then you put one on top of the other and all of a sudden you have a square. So that's really all these normalized earnings are doing, is trying to take the humps out of, the industry cycle or the business cycle. And it makes perfect sense. And we can do this in one of two ways. We can take a look at earnings per share, and we can take a look at return on equity. Let me show you a quick example of these two. So here we go. Following information, we've got 4 years worth of history. So we have earnings per share, book value per share, and return on equity, and there's a stock price of 25. So let's go ahead and do the regular old normalized historical average earnings per share that we learned back in kindergarten. Let's take those 5 EPSs and divide by 4, and we get the 636, and then put that in the denominator into the $25 stock price, so we get an average normalized EPS of $3.93. That's a super easy one here. Now what we can do, notice those return on equities, 20, 26, and 15. So we can take the average of that, but then we can multiply that by the current equity book value of share and get an average normalized EPS based on ROE of 822, and then divide that into the 25 and we get 304. So let me go back quickly here. So here our PE ratio is 393. Here our PE ratio is 304. So this is super easy math, right? But the interpretation of these are probably going to be a little different, and it's not likely that you're going to get the same answer using both of these methods. How about if we take the price earnings ratio and we put it in our calculator and hit the 1/x button? So we get what's known as an earnings yield, earnings over price. And the reason that we have done this over the years is because of what I said earlier. And there it is emphasized in that first arrow point, that a negative earnings makes a PE ratio meaningless. And of course, one of my responses to one of my sons in particular is, I'm pretty sure you haven't contributed anything to the household. And in fact, you've taken away from the household by having a bad attitude. So what do you do when you're trying to compare children like that? Of course, I'm exaggerating and I'm embellishing and doing all this. But it's an important point that, if you have a negative EPS, what do you say? You can say something like, okay, I'll do something else. I'll look at some other metric. Or you can say, you know what, this is probably transitory. I mean, hopefully the company, if we're thinking about investing in this company, we want it to be its executives to invest in positive NPV projects so that earnings is going to be positive at some point. On the other hand, if we're looking at shorting this stock, then negative earnings brings in a totally different specter. Nonetheless, it's still extremely important. Or we got to figure out, all right, are these negative earnings, are they persistent? Are they part of the core earnings? And of course, if we want to short that stock, then that's a great idea. All right, so how do we solve this problem? We use normalized EPS, right? Now, here, let me just go back here quickly. So that would get rid of, even if you had one negative EPS in there, on average, they would be positive, right? So you can use normalized EPS, or you can use the earnings yield because the price is never negative. Now, earnings in the denominator can still be negative, but look at the last arrow point there. Securities can be ranked from cheap to expensive using these ratios. And so you'll have positive numbers, and then you might have something that's close to zero or something that's negative down at the bottom. And then that gives you kind of a relative sense of this metric. Boy, this is a 1 or 2 sentence in the reading. Describe fundamental factors that influence these multiples. So let me just go ahead and read the 2 circle points at the bottom. And this is, you probably know this stuff, but this addresses this particular LOS. PE ratio, justified PE ratio, positively related to the growth rate of expected cash flows. I mean, that should make perfect sense. Inversely related to the stock's required rate of return, and that has some element of risk depending on how you want to identify risk. All right, how about multiples based on forecasted fundamentals? All right, so this is some really, really good stuff. But the great news for you is that, boy, we've done this in the free cash flow chapter. We did this in the Myron Gordon dividend growth chapter. So, boy, look at that equation right there. That looks an awful lot like the Myron Gordon growth model that we've talked about so many times in the past. But notice that on the left-hand side of the equal sign, there's P, right? That's the P in the PE ratio. So what happens if we divide both sides of the Gordon growth model by E? Well, that's what we get here. And notice that we put the E1 in bolded red font. And so the justified leading PE ratio is, well, there's PE, right? And then we divide both sides. We get the dividend 1 over earnings 1, and then that can be summarized by 1 minus B, right? B is the dividend payout ratio. And so look on the next part of the right-hand side of the equal sign. So this justified leading PE ratio is 1 minus B divided by R minus G. So you've got some fundamental things going on here. What is that? The dividend payout ratio and the retention ratio, that's all dependent on board of director decisions, right? The growth rate is a function of, remember how we called that G, that's sustainable growth. And we can compute that with fundamental analysis as well. And then the R, remember that's the required return on equity, which we get from the shareholders. Now we can estimate it using the capital asset pricing model, but we get the R from the shareholders, right? The shareholders look at us as executives and say, hey, you guys stink. We'll let you have money, but we're going to charge you 20%. Or they say to us, boy, you guys are great. There's hardly any risk. We're only going to charge you 8%. And here's some money, and then here's some more money on top of it. Right. All right, then we can go ahead. So there's the equation for the justified leading PE ratio. So make sure you have that top one memorized. And then the trailing PE ratio, you do the same kind of algebra there, and you get that all the way over on the far right side of the equal sign. All right, so let's look at a quick example here. Retention ratio 40. Required rate of return 10, growth rate of 3. So all we're going to do is plug in those numbers. We get a trailing PE of 883 and a leading PE of 857. Oh, what have we been doing so far? We have been taking the price and dividing it by earnings. But as I said earlier, we can divide it by almost anything that we want, right? Clouds in the sky, that doesn't make sense. But book value, that makes perfect sense. So just like back here, we went and did all this algebra. You can do the same thing here, and you get that, when I look at that right-hand side of the equal sign, I'm always thinking of the Myron-Gordon growth model. That's where you start. You end up with this when you're doing a price-to-book ratio. And here's just a super quick example. So we get a price-to-book ratio of 3. A couple of notes down at the bottom. That price to book is probably positively related to return on equity, and that should make perfect sense. And then the bigger the spread between the return on equity and the required return, that's going to result in a higher price to book ratio. How about price to sales? I remember going back at the turn of the century when we started buying personal computers and trying to figure out how we can use this thing on our desk at home. I'm going back to 95, 97. And then all of a sudden we have the internet. So, we're trying to think about what we're doing. And all of a sudden these new tech stocks and these new internet stocks, they don't have any sales. I'm sorry, they don't have any earnings. So we have to move up. We have to move up the income statement. And we came up with this price to sales ratio. When I was in graduate school, I never heard of a price to sales ratio. But we can do the same thing over there. Look at that top circle point, justified PS ratio. We can do all that stuff where we're given some variables. This is going to be a function of things like profit margin and earnings growth rate. And let's take a look at a quick example here. So we're given a bunch of stuff in this in this table, and we can substitute those numbers in there and get a justified price to sales ratio of 0.786. Here's a good LOS. This one could read something like, do you remember all the stuff that we taught you back in regression analysis? Well, let's go ahead and apply it here. Of course, you can use regression analysis to apply fundamentals to relationships between and among any kinds of groups of variables. So let's suppose that the PE ratio is a function of, look at the diamond points there. It's a function of beta, it's a function of the dividend payout ratio, and it's a function of earnings growth rate. So we go ahead and we collect information out there on, now you ready for this? Has to be similar stocks in similar industries, right? If we're collecting data on the boat industry, Malibu boats and Kraft and all the people who make boats, I don't want to throw Amazon in there as well. So it's got to be a collection of similar firms, and we can easily get data, right? We can easily get payouts and expected growth rates. We can get that from the consensus from all the analysts out there, or we could do it ourselves. Probably we don't want to do that, but it's out there. And so then we go ahead and use our regression analysis, and we get some results, right? So look at that the second part of the equation in the light gray box. Our predicted PE ratio using regression analysis, which we get from similar kinds of companies, is about 13, right? So, this is super cool. And, the thing that you have to remember is that you're relying on all of the assumptions of that simple linear regression model. And so if our assumptions are wrong, then this 13 predicted PE ratio makes no sense at all. Oh, here's some limitations here. What is that part? Explain limitations, right? So we should know this. Predictive power of the estimated PE regression for a different period is uncertain. Okay, so we can live with that. We know about that. Relationships between PE and company fundamentals varies with time. I mean, that's true. And then look at this last one here. You know, when I said dividend payout ratio and expected earnings growth, you should have had this pop into your head right immediately, right? Hello, McFly. You should have said, wait a minute, Jim, didn't you teach us that those independent variables, they have to be independent? And it sounds an awful lot like that dividend payout ratio and the earnings growth rate are probably related. In fact, they probably have a high correlation. So there we go. Regressions suffer from multi-collinearity. Oh, remember that one. Multi-collinearity. That's a great choice to have on your exams. All right, moving on here. Evaluate a stock. All right, by method of comparables, and then let's go ahead and see if we're over or under or fairly valued. All right, valuation. So here we go. Estimate the value of a stock based on a benchmark multiple, and then just compare it to the current market price. This makes perfect sense, right? If I'm a golfer and I have an average score of, let's say, 80, and I'm not going to compare myself to Phil Mickelson or Colin Morikawa or Jordan Spieth, because their average score is, probably 68 or 69. And of course, I'm playing rinky-dink golf courses here. They're playing super, super hard golf courses. If I played on their golf courses, my average might be 110. If they played on my golf courses, their average might be, 62 or something like that. So we need to make sure, and how do we do this? So there are the steps here. Calculate price multiple, select the benchmark, right? Make sure that the benchmark is of similar size and of similar risk. And then you can estimate the value of the company's stock using that benchmark multiple, right? I wouldn't want someone to say to me, Webb Simpson is the leader in 2021 for sand saves. I think Webb Simpson recovers 80% of the time he's in a sand trap, he gets up and down, which means he hits a shot and then he puts it into the hole. 2 shots on average. Me over here, I wouldn't want to compare that. I mean, I'm lucky to get the ball on the green when I'm in a bunker. So we want to make sure using the appropriate benchmark multiple. And then look at the purple there. This is what we want to do, right? So we can do this. We can do the first one. We can do the second one. We can do the third one. And I don't want to really say this, but lots of people can do that. But this is where we are. Investigate. This is our skills as a financial analyst. The asset may be mispriced. Check out the fundamentals. Okay, you've heard me say that 1 million times. All right, here's a good little slide on benchmark value. So industry peers, some kind of an index, a broad market index, firm's historical value. So I always tell my students, whenever they're doing something with a company, I say something like, okay, give me a trend analysis. So we can do trends for price to earnings and price to sales and price to book. We can do trends. And I caution them. I say, look, if this is a company like IBM that's been around for 1,000 years, I don't want you to go back and do 1,000 years worth of PE ratios, because probably 20 years ago is not too relevant. So I'll tell them to go back 3 or 5 years, right? So that makes perfect sense. Do a trend analysis, and then I say to them, go ahead and compare that to the competition. So that's that top left there, the industry peers. And then I say something to them like, I don't make my students do this. I say, let's suppose that we picked some larger group that includes some other firms other than our industry peers. What about some kind of a sector index? And then what if we compared that to the S&P 500 index? And I have lots of students who will say to me, Jim, that's not fair to compare it to the S&P 500 index because that's got 500 stocks. I'm just one stock. And I'll say, well, is that in the S&P 500 index? And they say, oh, it is. And I'm like, okay, so that's 1/500th. And so I give them this sense of, boy, it's so easy to compare things to a broad market index. Sometimes it's relevant. Of course, a lot of times it's relevant to make that comparison, but many times it's not. That's why, now don't listen to me here. You guys have to do all 4 of these, but in my class, I always emphasize the bottom right and the top left in my class. All right, peer company multiples. All right, compare it from the median and the mean for relative valuation, and then decide whether we're undervalued or overvalued. So look at the circle points we have in that light gray box at the bottom. If the stock's PE ratio is less than the mean or the median, then it's probably undervalued. If it's greater, then it's probably overvalued. That makes perfect sense. So let's take a look at a quick example here. We've got 2 companies, A and B. We have a trailing, and we have leading PE multiples, and we have 5-year growth, and then a beta. Oh, so that's important over there, some measure of systematic risk. All right, so what's the question asks us to evaluate the value and PE of each stock. All right, so what are we doing? Stock A has a lower PE than the peer median, right? So we've got 9 versus 12 and 7 versus 11, right? Even though it has, the same beta, right? And the same growth rate, right? 9%, and 1.1 and 1.1. So this is probably enough indication to say this is undervalued. B, on the other hand, that has a higher PE ratio despite having, oh my gosh, look, it has lower growth rate, 7, right, versus 9, and then it has a higher beta, has greater systematic risk. So we probably don't like B. We want to say that's overvalued. So then here's the great question. I mean, if you're a research analyst and you're finding stocks to recommend, I mean, A sounds like one that you would recommend, right? B, this sounds like one that has the potential to be a shorted stock. But then to short, remember, there are different kinds of risks with shorting. So you got to go in and say, okay, which clients is shorting this stock appropriate for? Not a blanket. Let's go ahead and short. How about if we divide the price earnings multiple by the growth rate? So when you divide by something, you're probably doing something called standardization process. And so what it does, it standardizes the PE ratio of stocks with different growth rates, right? Some stock has 5%, some stock has 8%, some stock has 11%. And here, let me shut off my brain, because what's going in my brain right now, you remember in one of those recent videos, we had we did the multi-stage growth rate. We had 2-stage and 3 stages and 100 stages. So we're forgetting about that. Remember, here in this context, we're looking at growth rate as it goes forward, maybe not for an infinite time period, but what's a reasonable, sustainable growth rate over the next year. All right, so we're looking for lower PEG ratios. We're looking for something that's less than 1. Limitations here: linear relationship doesn't account for differences in risk, and it does not reflect differences in the duration of growth. So this is what I was saying earlier here, is that what you probably want to do as part of the standardization process is you want to standardize the growth rates for just probably 1 year, and that's probably a practical application. But remember that it doesn't reflect the differences in the duration of the growth. That's why I mentioned the 2-stage and the 3-stage and the 100-stage. All right, here we have a target company and a peer group. What can we say about this company? Well, we have a stock price of 19. We have an EPS of 3. So we'll probably go ahead and divide 19 by 3 and then make some conclusion there. So there's 19 divided by 3. There's 633, and that's lower than the peer group of 8. So this is probably undervalued. We can do the PEG ratio, 633 over 7.5. That gets us 844. That's lower than the median PEG ratio of 110, undervalued. And then the intrinsic value, we can just take the 8 times the 3 and get 24, and we can say the company is undervalued. All right, how about explain the use of price multiples in determining terminal value? Well, You know, terminal value, that's just some kind of a future value. So it should reflect the rate of growth that a firm can sustain over the long run. So we can use any of those price multiples to estimate the terminal value. I mean, let's just take two quick ones here. Terminal value based on fundamentals, we can take that justified leading PE ratio times the forecasted earnings. Or on comparables, we can take the benchmark PE ratios times those forecasted earnings. Let's do just another quick example here. What do we have? Required rate of return 10, EPS forecast 140, and there's some values for the peer group. All right, so what are we going to do? Let's use Gordon growth model. So D5, right? So let me go back here. What did we say? Estimated forecast for 5 years, 1.4. So that payout ratio is going to be 49 cents, right? So our retention ratio is going to be 65 times the 6%. That gives me 3.9. So I'm going to use that 3.9% as the growth rate. And if I do all the math in the Gordon growth model, that gets me 835. And I can use the PE ratio of 8 times the 1.4 to get me 1120. So I did this terminal value. I did this using the comparables, using the Gordon growth model. And notice that that mean dividend payout ratio for the peer group is 35. So that's why we put that 65% in for the retention ratio. So we're just assuming, remember this is similarities. And that mean return on equity, 6%. So that growth rate is based on the fundamentals that are occurring among our peers. Oh, here's an LOS that you can say, oh, hey, Jim, we just did this recently in that cash flow reading. So here we go. Definition of cash flows. We can start with earnings per share and then just add the non-cash charges. We can take the cash flow from operations from the statement of cash flows. We can compute free cash flow for equity, and then we can go to the income statement and get EBITDA. And then look what we have on the far right arrow points there. So that first one in the purple ignores non-cash revenue, so that's important. Cash flow from operations requires those adjustments that we talked about earlier. Free cash flow to equity, look at that middle arrow point. Most valid, but has the potential. It has the potential to be volatile. And remember, it has the potential to even be negative. All right, let's move on to enterprise value and these multiples here. So an estimate of pre-interest, pre-tax operating cash flow, total value of the company. And it's a value indication of the overall company rather than just the company stock, right? So there's our formula on the left-hand column that we probably should have memorized from level 1. Enterprise value, so we have market value of common equity, market value of preferred stock, market value of debt. Now look, I shouldn't have to tell you this, but M&M, Modigliani and Miller should be ringing in your brains right now. We get that from M&M. And then we go ahead and take out the value of cash and short-term investments. And, this comes directly from 1958 when M&M said something like, as shareholders, we'll never pay executives to do something that they can do on their own. And so you got to take out the cash because investors can have cash. And you have to take out short-term investments because investors can have short-term investments. So that should make perfect sense. A couple of fundamental issues over here on the right-hand side. EV, positive related to free cash flow to the firm growth, positively related to the ROIC, negatively related to the weighted average cost of capital. That makes sense. And so once again, if the company EV over EBITDA is less than the benchmark, that's undervalued. And if the arrow goes the other way, then it's overvalued. And there are a bunch of other multiples there as well. Let's go ahead and take a look at a quick example. Let's go ahead and compute the LOS asks us for the EV divided by the EBITDA, depreciation and amortization multiple. So we have a bunch of stuff given to us in the problem. So remember from back here, what are we doing? Let me go back to, all right, so there's our formula there. We're going to do some adding and subtracting. So let's see what we come up with. So the market value of the equity, 1.6 million. Where did I get that? Okay, so market price per share, 16 times the 100,000 outstanding shares. So that's 1.6 million. Add the market value of the preferred stock, add the market value of the debt, subtract out the short-term investments. So you get 5, right? There's the enterprise value. And then we can get, some measure of, operating income, EBIT, and then add back depreciation and amortization. So you do all that. And so there's the EBITDA multiple of 1.79. All right, how about if we're trying to compare a U.S. chocolate company with a global chocolate company? Hershey and Nestle, different accounting methods, different economic conditions, different cultures, different risk and growth opportunities, and then somewhere in a merger of economic conditions and culture, I would throw in, differences in laws and regulations and political risks. So let me just read some of these circle points here, because the LOS asks us just to explain, right? So PEs for individual companies in the same industry vary widely across borders. So if you have 2 chocolate companies in 2 different countries that have PE ratios of 20, they're probably not identical PE ratios. And that could be for a variety of reasons, but one great reason is differences in accounting standards. But then again, you should say, wait a minute, Jim, didn't we have that entire reading on the international standards and US GAAP and how they're trying to merge together? And yet they are merging, but they have not totally merged. So what we need to do is identify those that are least affected, price to free cash flow to equity, but more seriously affected are almost all of the other ones there. So remember, look at that last diamond point. Choice of accounting methods and estimates by management is going to influence, those more seriously affected multiples. Oh, momentum indicator. So what do we know? That price can have momentum, right? It can either go up and everyone's looking at it and saying, oh, that's just going to keep going up and up. So there's some kind of a behavioral issue when that price goes up or that price goes down. So what we need to do is make sure that we're aware of earning surprises, we're aware of unexpected earnings, and then we're aware of relative strength. So look at that bottom circle point, economic rationale. Positive surprises may lead to persistent positive abnormal stock returns. And so make sure that you're aware of what that earnings surprise is. Reported EPS minus expected EPS. And we hear this all the time. If you watch Fox Business News or MSNBC or you read the Wall Street Journal online like I do, I do all this stuff. Analysts were expecting $2 a share, and this company produced $2.40 a share. Oh my gosh, look at the stock price. It's soaring today. Or sometimes it's falling on that day, depending on events that are going around. All right, so let's do this standardized unexpected earnings. And let me go ahead and just take a moment and pause. And when I had one of my econometrics classes in graduate school, my professor was a big fan of accounting research. And so he made us go read some really top-level academic articles that were written in accounting journals. And this is where we came across this concept of standardized unexpected earnings. So notice we have earnings surprise divided by the standard deviation. So once again, we're taking a return and risk, earnings surprise over standard deviation. So look at that first arrow point. It scales unexpected earnings by a measure of the size of historical forecast errors. And so this is really, really important. Now, we can also look at relative strength indicators. What this will do is compare stocks' performance during a period of past performance, which I talked about trend analysis, or with a group of stocks. And what we're trying to do is identify persistence in earnings, and we're trying to identify inflection points in case that persistence or that sustainability reverses. How about getting to the end of these LOSs? So arithmetic mean, which we learned in kindergarten, and the harmonic mean, which we never learned. I mean, one of my professors in graduate school mentioned harmonic mean, and I had to go look it up and say, okay, tell me what this is. But there's a really good example here that shows this. So the arithmetic mean, that's the mean that we've used for all of our life. But the harmonic mean is reciprocal. So we're going to take an n, right, and we're going to divide that by 1 over whatever the variable is. And I'll show you what that means here in just a second. So look at stock A and B at the bottom table, market caps, earning, and PE ratios, right? So here's our PE for the portfolio for stock A and stock B. So all we're going to do is take the 515 and the 485. So there's our total market cap of 1,000, and divide that by the two earnings of 41.5 and 23.5. So 1,000 over 65, that gives us a PE ratio for the portfolio of 1538. All right, so notice that that's different than the arithmetic mean of those two PE ratios, which turns out to be 1652. All right, so think about that. That's a huge difference there. Now, what we can do is we can weight that mean by the size, relative size of stock A and stock B in the portfolio. That's what we do in that third diamond point, and that gets us yet to another one, 1637. But now we can do the harmonic mean. Are you ready for this one? Harmonic mean. So n, right, is in the numerator. So there's 2 divided by reciprocals. So we're going to say 1 over 1241 plus 1 over 20.63. And that gives us an harmonic mean of 1544. And then we can weight it. Just like we weighted the arithmetic mean, we can weight the harmonic mean, and we get to 1550. Now, let me just pause here for just a second. I have a good slide coming up, but this says explain the use of these things to describe central tendency of a group of multiples. All right, so what in the world are we doing here? Notice that the harmonic means are less than the arithmetic means. That's important. And let me just say this to you. The harmonic mean is used in finance all the time, but it's used in lots of other disciplines. But what it does is that it reduces the value of outliers. And that's the important part of using the harmonic mean. So let's look at some conclusions here. Harmonic mean less than the arithmetic mean. We know that. It gives less weight to higher P's and more weight to lower PEs. All right, so that mitigates the impact of large outliers. I think if you remember that, you'll be able to answer any question on this thing here. And that takes us through, what did I say earlier? R. However many numbers goes up to R, that's what we've done. There's really been a theme throughout all of these LOSs, and that theme is, boy, I don't want to just identify the PE ratio, but that theme is, let's go ahead and compute it, and let's go ahead and figure out what it means, not only for one company, but what does it mean for trading on the floor of the New York Stock Exchange, so that ultimately we can decide, look at that last LOS. That's the most important LOS here. Decide whether a stock is over, under, or fairly valued. That's the most important one. How do we get there using multiples? Well, then all of these are super important.